Okay, so I'm really delighted to welcome Carolyn Kousky here to our webinar series. She joins us from the Wharton School at UPenn, where she's the Executive Director of the Risk Management and Decision Processes Center. Her scholarly work lies at the intersection of climate science and environmental science and risk management and public policies, which is perfect for what she's talking about today, which is going to be about how we can design an insurance product that reaches underserved groups, especially low-income groups, and protects them from some kind of climate risks that we're all increasingly going to face and that are particularly burdensome to poor people. So welcome. I guess we're going to run this in the usual way, which is, Carolyn, you've got the floor for, half an hour, 40 minutes, 45 minutes, whatever you want. Anybody who wants to chat me a question or use the raise hand function is welcome to do that. And before I step into the background, I just want to remind you that our last event of the semester will be next week, where Pat McCoy, my former colleague, will be talking about large issues of financial security especially for poor people. Okay, Carolyn, the floor is yours. Thank you again for coming.
Thank you for the invitation. It's really wonderful to be with you all this afternoon. I'm going to see if I can share my slides here and start this. All right. Does that all seem to be working?
Beautiful.
Okay, great. Peter, feel free to, if someone chats you a question or has a question and I'm not realizing it, just interrupt me as we go along here. So today I'm going to talk a little bit about different inclusive insurance models. And we'll get to this, but what I mean when I say inclusive insurance models is any policy or program that's designed to meet the needs of those who are currently unserved or underserved by the market with appropriate and affordable insurance. So we'll get into what all that means in a little bit. The term has really emerged globally, coming out of sort of microinsurance and index insurance programs in the developing world. But at our center, we've had now several different projects that are all thinking about what it means to have an inclusive insurance market for, specifically, we've been looking at disasters in the US. So I'm going to start with some motivation about what kind of brought us to thinking through these concepts. And then I want to tell you about some pilot projects that are kind of examples of what inclusive insurance could look like in the US context. So we'll just jump in with a little bit of motivation, and that is that there's now a very large body of research across disciplines, methods, that really all points to the fact that lower income groups and communities of color suffer disproportionately from disaster events and recover less quickly than more privileged residents. Now, underlying kind of that observed inequity in disaster outcomes is a whole bunch of different things. So one is that there's actually inequity in who's exposed to the actual physical risk itself, who's located in high-risk areas. There's inequities in the safety of homes and construction, in access to preparedness resources, in access to information. But a lot of what we see driving these inequities has to do with inequities in funding for recovery and access to financial resources in the recovery process. So that's what I want to focus on today. And I really have been looking at disasters through this lens of them being negative financial shocks for households. There are times when expenditures really go up. So property damage from a big disaster event, right, can be thousands to hundreds of thousands of dollars of damage. We also have some survey work about recovery at the center that really documents that the cost to a household of experiencing a disaster are also much broader than just the property damage. They also include things like, the debris cleanup and mucking out the house and excess cost of transportation because roads and infrastructure might be down, or oftentimes also these are things like when utilities go down, having to pay for generators and fuel. And there are also times when income goes down as well due to all the business interruption as well. So they're really these negative financial shocks. And in order to cover all these costs that households face, there's really 4 sources of dollars. And the challenge is that low and moderate income households struggle with access to all of these. So you could think about using your savings to cover these costs, taking out a loan, using government assistance or aid from somewhere else, or having insurance. But I want to talk through each of these in a little bit more detail and some of the challenges that lower income families face with each of them. So the first, I'm sure you've seen statistics like this before. the basic point is that the majority of Americans don't have enough liquid funds for any type of disaster event. When we're talking about thousands to tens or hundreds of thousands of dollars in damage, they simply don't have enough in savings accounts to cover those costs out of savings. I also want to note, though, that we do see after disasters that often households do have to drain the savings they have. And sometimes in some of the, and I'm saying this because some of the research might look at outcomes like how much debt people have after a disaster, but it's often very hard to track that some of the really negative financial consequences might be that you have drained all your retirement savings or your kids' education on a disaster. And so you're in a much worse, financial position than you were before the disaster. But even when families use up some of their savings, it's usually insufficient to cover all the costs. The first line of defense after a disaster in the US is actually a loan. This is where the government pushes you first, is to the Small Business Administration, and they run the disaster loan program for households. And we've been looking at that data at our center, and you basically see that as income goes down, the denials go way up. And so low income households are essentially locked out of access to credit after a disaster because they use things like debt to income ratios and credit scores as qualifications for getting a loan, which makes sense. And it's also the case, though, that it's probably not necessarily helpful to even open up these credit markets for certain households who would never have the income to even be able to repay the loan. And so sort of straddling them with debt that they can't get out from under is not a good answer to financing their recovery. So if they don't have savings and they don't have a loan, then lots of people think that's where the federal government comes in to help you. And the kind of one sentence summary on federal disaster aid is that for households, it's insufficient and too delayed. So I'll now say a little bit more detail about that. But when people think of federal disaster aid, they're often thinking of the FEMA Individual Assistance Program. These are the grants that are given to people after a disaster. They're not taxable. But these grants are capped. They tend to be on average, maybe about $5,000. The numbers you see here are from Harvey, but you see the same, these same types of numbers, no matter which disaster you look at. And that's because these grants, what I think is not well appreciated, is that they're only to make homes safe and habitable again. They are not designed to bring you back to pre-disaster conditions, and they were intentionally designed that way so that there wouldn't be this moral hazard problem of people relying on the government for post-disaster recovery instead of buying insurance. So they're intentionally limited to kind of push people into purchasing insurance. And you can see here with Harvey, right, the flood insurance claim was like 2 orders of magnitude larger, right, in terms of what people get in order to rebuild. But the problem is, right, that lots of people can't actually afford the insurance, and that's who we're going to be focusing on today. This might, though, for those of you who haven't spent a lot of time thinking about federal disaster aid, you might think this doesn't quite square with the fact that you see headlines that there's like billions of dollars appropriated after like all our major hurricane events, and where's that money going if it's not going to households? So I want to say a bit more about some of the aid that comes. This is actually a graph that I took from the Caribbean Risk Insurance Facility, and they were talking about the dynamics of post-disaster assistance for small island nations, but it actually perfectly captures the same dynamic that we see for communities in the US. And so after there's a disaster event, there's some immediate influx of dollars. These would be like the FEMA grants I just talked about. And then for our really big disasters, so like those major hurricane events, Congress often typically appropriates money to the Department of Housing and Urban Development through the Community Development Block Grant Disaster Relief Fund. It's a bit of a mouthful, CDBGDR. And that's where you see those tens of billions of dollars going out in terms of federal disaster money. But some work by a colleague looked at the timeline of all of these and showed that the sort of median time between when a disaster happens and when those HUD dollars make it to the community is 2 years. And that's just when the first dollar makes it to start being spent. And then it's typically years and years for that money to be eventually used by the community. So that's all to say that all of that is really about long-term reconstruction. It is not about helping people in the immediate aftermath of a disaster. And we see this very big gap right here in sort of like the weeks and months after a disaster, when lots of families, and particularly low-income ones, really struggle without access to the resources they need to have basic needs met for them. That, though, right, is something that could be really nicely filled by insurance, which is where we're going. Okay, but for the moment right now, federal aid's pretty limited in terms of the help that it gives to people. And I guess while we're on this topic, maybe I should have mentioned there's also been some emerging research. I'm sure some of you have maybe seen some of these papers that's also showing that, for example, the FEMA grant programs, while there's nothing on paper that would suggest that they're discriminatory or anything, when you actually look at where the dollars go, they tend to go to whiter and richer areas. And part of that has to do with what in my head I kind of think of as procedural inequities, but it's difficult to get this money, the kind of paperwork and like appealing your denials and being sent back and forth between FEMA and SBA, and it's confusing. And if you don't have time or money to kind of navigate that system, you don't get the money either. So the money tends to go to people who are already privileged because they're the ones who can access it. Okay, so that means that the populations we're talking about don't have enough savings, don't have access to credit, aren't getting made whole through federal aid. You know, maybe their friends and family, social networks could provide some help to them. But of course, we know in a disaster, if your social network lives near you, they're also struggling at the same time. And we've been doing these surveys now after some of the major hurricanes about financial recovery. And we see that less than 10% on average of people say that their friends and family were able to make any kind of meaningful financial help, probably because they're struggling at the exact same time, right, that the respondent is struggling. Okay, so that leaves insurance. But when it comes to disasters, we see this big disaster insurance gap, right? And this is true globally. This is showing you the data from Swiss Re. They estimate that about 2/3 of losses from disasters globally are uninsured. But even here, where we have very robust insurance markets, the disaster insurance gap is not much smaller. A lot of our disaster losses here in the US also go uninsured. So why is that? Well, when we're thinking about property insurance, most homeowners have their standard homeowners insurance with some deductible. But then when it starts coming to disasters, all of a sudden their coverage starts going away, right? So first to note is that for lots of disasters like hurricanes and earthquakes, most typical homeowners policies come with much higher deductibles. Like in the Southeast, these are referred to as hurricane deductibles. So maybe you have to pay the first $500 or $1,000 of a loss from any other type of damage. But when it comes to a hurricane, you have to pay 2%, 5%, 10%, 20% of the loss. And then your insurance kicks in. So it puts a lot more of the cost back on the homeowner. And then we also see lots of things like flood damage and earthquake damage are just excluded completely out of standard homeowners policies. And we're starting to see more and more other types of limits when it comes to disaster losses. So things like maybe some of you saw the reporting after the Texas ice storm that people who had sort of completely insured to value for their home found that when the pipes burst, oh, there was a sublimit that we only get $10,000 for burst pipes, even when it cost us $30,000. And so these kind of hidden sublimits, we've also seen sublimits like that around roofs for things like hail and other types of damage. And then also other types of coverage like additional living or having replacement cost coverage for your contents are sort of extra things that consumers need to add on and pay more for, and they often don't even know that they should, or they just kind of see the higher costs and don't. And so what happens is that when a policyholder goes to kind of get reimbursed for disaster damage, they realize all these kind of limitations and they don't have enough to kind of do everything that they need to do. Now, to focus on the kind of disasters that are excluded, so like floods are just not included in your homeowners, but I'm sure everyone listening today knows, right, that we have our federal flood insurance program. So you can purchase a separate flood insurance policy to be covered. And of course, there is a federal mandate that if you have a federally backed loan or a loan from a federally regulated lender, and you're in FEMA's mapped 100-year floodplain, also referred to as a special flood hazard area, that's a requirement on your lender to make sure that you do indeed have a flood insurance policy. We looked at kind of take-up rates around flood insurance in the US, though, and that's what you're seeing here. You're seeing this as a county map. These aren't take-up rates at the level of the county, they're at the level of that 100-year floodplain. And so the numerator is the number of residential flood insurance policies, and the denominator is an estimate of the number of residential properties in the 100-year floodplain. And what you can see is that our federal flood insurance program is very much a coastal program. Take-up rates along the kind of hurricane-prone coast are actually really good, in excess of 60%, often in excess of 80% of residents in those high-risk areas have flood insurance. But when you look at inland flood risk, it's very poor, and only, most of this is like under 20% of people in the floodplain, in the FEMA mapped floodplain, only, less than 20% have a flood insurance policy. Of course, there are some exceptions, right? Like Sacramento is a hotspot of flood risk, so you see more policies there. But this is also just defining flood risk as FEMA does it with these maps. And for those of you that have thought about flooding, I'm not sure how many of you that is, but you might know that these maps don't include all sources of flood risk. So they don't include rainfall related flooding, for example. So it's a real underestimate of the number of people at risk. So these take-up rates are also then underestimates of the number of people who are at risk of flooding. Okay, so this is all to say there's lots of people who don't buy this extra flood insurance, which explains part of the disaster insurance gap that we see in the US. And there's lots of reasons for that, right? So some of it is lack of understanding and information about the risk. I could actually spend all evening talking to you about what I see as failures in our country's communication and disclosure when it comes to flood risk and disaster risk more broadly. So that's part of it. We also have a little bit of work at the center that seems to suggest that people don't have very good insurance literacy, and maybe there's people listening who could share further insights on that. But we have a couple surveys that seem to suggest that people think that insurance is kind of a very different product than most other things that people buy, and they often don't understand sort of the risk management role that it would play. And then, well, we have difficulties with the supply of disaster insurance. I'm going to put that on hold for a second. The real focus for kind of my presentation tonight is that a lot of it is just affordability, right? And folks cannot or don't want to pay the high costs of disaster insurance. So the problem, though, with this is that we know from research that people with insurance recover better and recover faster than those without insurance. And that's because of everything we just talked about. There's all these limitations of other sources of post-disaster financial assistance, such that if you have insurance, it's really beneficial. And the research looks at kind of different sort of metrics of what recovery is, but in general, you find things like those with insurance rebuild faster, are more likely to rebuild, have higher self-reported sort of self-reports of recovery, and so forth. I mentioned we were doing these sort of surveys after hurricanes. We also see the protective role that insurance plays for people in that. So we've asked, this is just some preliminary pilot findings after Hurricane Michael, but they kind of demonstrate this point I want to make about sort of all the benefits that insurance provides in terms of recovery. And what you see is that we asked people whether they had to engage in these sort of costly coping mechanisms after a disaster because they didn't have enough access to financial resources otherwise. So did you have to sell personal belongings, or did you have to reduce your spending on other things like medical care or consumer goods? Did you fall behind on any of your bills, like your credit card or your utility bills or your mortgage? Did you have to take on extra work? And what you see is that if people had insurance, they were much less likely to have to do any of those things. And they were much more likely to say, no, I didn't have to do any of that. So it provides this financial protection against these kind of very costly coping mechanisms as well.
Carolyn, I don't mean to interrupt.
Please,
and I'm
no,
not
I
one of
want
those.
you to, please.
I'm not one of those causal inference fascists like some people are, but I mean, are you confident, just impressionistically, that this is the role of insurance as opposed to the smart people who already have other assets and who already have planned ahead and are the ones who buy insurance? So it's not really the insurance so much; it's insurance in addition to all the other things that those people might be doing, like just a selection effect kind of thing.
Well, for this graph in particular, no, I don't want to make the claim this is causal at all. This is like a preliminary pilot survey. So just for that. For the point more broadly, though, I mean, it's a difficult question you raise, right? Because some of these things are very highly correlated. So, you know, households that can't afford insurance also can't afford lots of other things, and lots of other things that might also be beneficial for them in terms of their recovery. So I think it's actually a difficult empirical question on how to separate out the unique contribution of each of those. I think right now we can just be sort of confident in saying that those constellation of things tend to go together and are associated with much poorer and much longer recoveries. So no, I'm not going to kind of say that it's only insurance, but I think I do think that a lot of this has to do with simply having the money to have a safe home again. And there are many ways you could get money to have a safe home again. Insurance is one of them. I'm focused on insurance in the pilots I'm going to show you in a few slides and in this talk, I guess, because sort of based on everything I just said, I find it difficult to try to achieve the goal of more equitable recoveries through any of the other channels, by which I mean, I don't see any mechanism to like dramatically increase the savings of all low-income people in the country so that they have a better financial buffer next time a disaster comes. I don't see that taking on more debt is actually a useful tool for this population. And while we've done lots on how to make our disaster aid programs more equitable, and there are very important policy reforms that I 100% stand behind, I am not confident that Congress is going to be necessarily acting on them anytime soon, although obviously FEMA under the current administration has done a lot to reform some of the known challenges with equity in their recovery. But so given the difficulty of achieving forward progress on those three, that kind of motivated our center to think about the kind of progress we could make using insurance as a tool. Did that answer your question at all?
Yes, it did. And I guess my other question is, like, do you envision some follow-up work that you guys might do to try to do experiments or get other kinds of, evidence on this? Or maybe the answer is you don't even need to. Like, okay, just let's do this and see what happens.
Well, this is actually a sort of separate conversation that I'd love people's thoughts on, because we've been struggling actually with how to do some really good empirical analysis when, unfortunately, and you'll get to this in a little bit, this will come back. So maybe you could comment in a few slides when I'm telling you about what we're doing in New York City, where we're helping to pilot this inclusive insurance program. And what we'd really like to do is be able to do sort of like a randomized controlled trial where we kind of implement this in some areas and not others, and then see if it's made a difference, right? The problem with that is that we're talking about disaster insurance. And so we're talking about implementing a program and keeping it going in the hopes that maybe one day there's a disaster, and maybe that's going to be 10 years from there, and we have no way to maintain the program over that time period. And also, when ex ante it feels like it's likely going to be beneficial, our community partners don't want to randomly kick people out of it just in the interest of research design, right? So we're running into some of those challenges, but I agree with you that that's kind of what you'd want from a research perspective. And if you or anyone else has like thoughts on how to get at some of these questions better, I'd love to hear it. I mean, the other challenge with looking at this, and because I recently reviewed a lot of the literature on the impact of insurance on outcomes, and insurance companies don't want to share their data, and certainly not at a property level. And the NFIP won't share the addresses, and so you don't know who doesn't have insurance, right? So all of this is sort of aggregated just to say, like, the share of these people, the share of this county of insurance is greater than that, and trying to infer patterns that way. But what would be a really nice research would be if you could actually have different households with and without coverage, and then like look at their recovery trajectories. I don't know if you have any thoughts.
Not offhand, so keep going, but I will keep thinking about it.
Okay, yeah, that's a good question. Okay, so this was to suggest that there's these lines of evidence that insurance provides these benefits for households. There's also some emerging things, and I'd say maybe half a dozen studies that kind of are pointing at this direction, that as take-up rate within a community, or several of these are actually studies at the level of a country, or a country increase, you can have sort of beneficial outcomes at that level as well. So as take-up rate increases, you have a less negative impact on macroeconomic indicators after a disaster. You see that recovery, which is often measured in terms of things like rebuilding, happens sooner. And there's at least one paper that suggests that credit ratings might not suffer as much. So I see this as another one of those areas that's in need of much more research on sort of the role of sort of widespread disaster insurance on more societal level outcomes after a disaster. And we've heard sort of anecdotal conversations with local officials that, maybe there's also other pathways that haven't even been explored in the literature. Like, as more people in your community have disaster insurance, does that reduce the fiscal burden on the municipality after a disaster? For example, does it increase post-disaster tax revenue? Buildings are, homes are rebuilt faster, the property values decline less, that type of thing. Or does it lessen out migration because people have the resources to get back on their feet? Or does it reduce the burden on the type of municipal services? So I think there's a lot of interesting research questions in this space that we just don't have answers to right now. I would say, though, that there is quite a bit of work that I think supports this broad point that financial resilience is pretty foundational to all other forms of resilience and recovery. And that's because if you don't have the financial resources to do the sort of very basic things you need to be safe again, it leads to, and this is some of the findings from some of the literature, things like negative impacts on emotional well-being and mental health. I mean, I think that's very intuitive. If you don't have money to get into housing and to provide for your household, right, then of course that's very stressful. In other countries, there's been some work showing that it can often impact educational attainment, particularly as family members are forced out of education and into work to get more resources, that it can have impact on stability of families, and then protection against sort of longer term financial costs like this, limiting the ability, for example, to build wealth, like I was talking about earlier, by depleting your savings or whatever. So the basic idea is that kind of having those financial resources can be more broadly protective to all these things for the household. And I'll say I didn't put all these things up on the slides, but we actually have done a literature review of all these things. And if anyone's interested, I'm more than happy to share it afterwards. Just send me an email. Okay, so this was all the kind of motivation to tell you why we've been sort of really interested in this concept of inclusive insurance. And looking across how it's been used globally, we've been using this kind of slightly modified definition of referring to any policy or program that's designed to meet the needs of those who are currently unserved or underserved with both affordable insurance and appropriate insurance. And of course, insurance can be purchased at all scales. Globally, what we've seen, a lot of inclusive insurance tends to just be referring to microinsurance. We've been looking at other models as well, although there's also been some meso insurance models, by which I mean a nonprofit or a community group purchases insurance on behalf of other people. I'm going to tell you about one pilot of that in a second. And then, of course, you know, there's sovereign level, country level insurance, but I'm not going to be talking about that today. So I'm assuming these terms are pretty familiar for folks on the call, but in case not, the two examples that I want to talk to you are both examples of parametric insurance. So just to be clear, what I mean here, so most standard insurance in the US, right, is indemnity-based or payouts related to your damage. You know, when you suffer a loss adjuster has to come to your house and you only get paid, right, the cost to repair the damage. Parametric insurance is quite different. After a hazard, you get paid a predetermined value if some observable metric of the hazard itself is exceeded. So for example, if wind speeds within so many miles of my home exceed some threshold, I automatically get some payout like $10,000. Parametric insurance has been used for quite a long time. Bringing it to the level of kind of household or an individual is more new, and there's been a lot of exploration lately on whether these types of models could play a role in sort of building climate resilience to increasing extremes. And of course, right off the bat, you know, there's real limitations to this, right? Parametric insurance is not going to replace an indemnity product. It can't replace homeowners insurance when that's what you really need. But there are two things about it that are really nice that can help fill in other challenges with recovery. The first is that it's so much faster, right? And so we know that the time it can take after a big disaster, in particular, when like there might not be enough loss adjusters and this type of thing, and there's an overwhelming amount of claims to process, the amount of time it takes for insurance claims to be processed is quite long and can stretch into the months. You know, at the very extreme end, we saw some folks in Puerto Rico who were not getting claims for like out to a year. Usually it's a few months, but for a low-income family, those months matter because you don't have another financial cushion to sort of tide you over in the meantime when you're waiting. And so a parametric policy that might sort of only be a small amount, but is given to you on day 2 after the disaster can really fill that need. So that's one thing. Also, parametric insurance has much lower transaction costs because you don't have to go and adjust the loss. You just look at this independent measure, and there's also then typically fewer you know, legal expenses and stuff because it's not as contested. And so that lower transaction cost also is what opens up the ability to write these kind of smaller microinsurance policies, which is the first thing I wanted to talk about. Microinsurance was really sort of the start of inclusive insurance. And I'm sure many of you are familiar. There's been lots of pilots rolled out across sort of developing and emerging economies across the world. So microinsurance tends to be defined as policies that have lower premiums and also lower coverage limits and are designed for poorer populations. So there's been all this implementation of microinsurance globally. And our center has been working with a foundation the last couple of years to look at what it would mean to bring microinsurance to the US. And could we adapt some of these models from elsewhere in the world to help low-income populations here in the United States? And until last summer, there hadn't been any microinsurance in the United States, but Puerto Rico is the first place to have adopted enabling regulations for microinsurance market. And there is now microinsurance being sold in Puerto Rico, which I'll tell you about in a second. But so the first sort of work we did on this topic was looking at how microinsurance is distributed and sold and designed around the world to figure out what type of distribution models might work in a US context. And one of them is this sort of aggregator or meso insurance model that I'm going to tell you about a pilot of this that we're doing right now in New York City. So I'm going to pause on that one. The other ones, you know, a lot of the microinsurance around the world is done on mobile phones. So you can buy your policy, and then also your claim is deposited right into some sort of mobile money platform on your phone. So this is also something that works really well for an unbanked population. And we know in the US that over 70% of adults that are making less than $30,000 a year still have a smartphone. So you could still reach a large share of that population. Of course, you could also have some of our public sector disaster programs do this, whether it's like the state wind pools or FAIR plans or the National Flood Insurance Program. We've had a few conversations with Fema about it. We know globally also that microinsurance tends to often be linked to other types of products or programs. And part of this is, of course, because it's very difficult to motivate anyone to want to purchase well, I guess any kind of insurance, but disaster insurance. So these would be things like, you know, you go to buy some agricultural inputs, and that purchase automatically comes with some type of weather parametric product to help you in the event of severe weather that would damage your crop, for example. So we've looked at whether you could couple things to like lease agreements or other existing programs to provide some type of baseline disaster coverage for people. And then we're also talking with Washington, D.C. about whether municipal captives could offer some type of microinsurance, but not very, I think DC might be pretty unique in having their own captive. So that's not a very widespread type of distribution model. Okay, so this was kind of theoretically the different ways that it could be done, but we also found that, you know, in most places around the world, microinsurance still, even though you can get the premium fairly low through the kind of transaction cost savings and the lower coverage, often it is still, the premium still cost shared in some way through philanthropy or the public sector. And that probably would need to be the case in the US too. But Puerto Rico has tried to create a sort of more robust private market for microinsurance. And so they've adopted regulations to kind of explicitly define microinsurance as its own class of products. And to kind of meet that, it has to have certain things. You have to have the payouts within so many days. The premiums can't exceed certain amounts. They've also created a new role of a microinsurance distributor, because often you're trying to reach populations that might not be going to a licensed insurance agent, and so you want other people to be able to sell it. And now at least one company has been selling microinsurance fairly successfully on the island. I think my last time I talked to them, there's a couple more offerings that should be coming online soon. So yeah, it'll be interesting to see. And maybe this is one of those places where there could be some nice research design on the impact of these types of products. So that's the first one. And now I just want to end by telling you a few minutes about what we're doing on this in New York City right now. But I'll pause for a second if anyone wants to ask.
Can I just ask quickly about Puerto Rico? Like, do you have a sense of what they're charging and what you get? It's so if you go back a slide, you know, you can't be more than $21 a month, but is that for 10,000 of coverage or 50,000 or 2,000, or like, what are you actually getting for that?
Well, so it's going to vary by the company that's offering it, because they are only telling you what the premium can be, not what the coverage can be, right? The one product that I know is being sold fairly in a, and I don't have any idea the exact number, but seems that they've been able to successfully be selling policies, I think is a $10,000 payout. And it covers hurricanes and earthquakes. And I'm not sure exactly like what frequency event it's paying out for, right? Because that would be the question. Are you getting $10,000 for a Cat 1 and above, or only for a Cat 5, right? And I don't actually have the answer to that. But I do know you could go on their website if anyone was interested, and they show you past 50 years of like past events in Puerto Rico and whether and how their product would have paid out.
And who's the they?
Oh, this is a company called Raincoat Insurance.
Yeah, that was in your paper. Sorry.
Yeah.
Great name too.
Yeah. Yeah. They've also done some things though, like they've been selling they've teamed up with a nonprofit, and they've been also just outright buying policies for sort of the lowest income people on the island in conjunction with this nonprofit. They've also been doing some fairly interesting testing of coupling their product to other types of things with partnerships with companies. Like they had a partnership with a car dealer who, instead of putting their cars on sale at the start of hurricane season, said, you buy our car and it comes with a hurricane parametric product for you, which is kind of interesting. Yeah. So, oh, the one last thing I'll say on Puerto Rico is we've also heard that part of the interest in Puerto Rico in parametrics, I'm sort of framing this as maybe a type of tool that could provide some amount of coverage for people who otherwise would have no insurance because they couldn't afford anything. But they're actually seeing that a lot of interest in this type of coverage for folks who have really lost trust in the insurance industry after Maria, when it was felt that, I've not looked into this, so I'm not saying one way or the other whether this is true or not, but there's a perception that claims were not paid quickly, were not paid fairly, that there was a lot of denial of claims and sort of poor customer service. Again, I don't know if that's true, but there's kind of this perception and the idea of parametric insurance where you don't have to deal with, you know, arguing over how much you are owed. You just get the money when the triggering event happens, was apparently very appealing to some customers. So take that as you will. Okay, so let me now turn to the New York City pilot. So we are halfway through this project. So this is just a work in progress. And this is a National Science Foundation funded project through their Civic Innovation Challenge, which is designed to partner cities with communities, with researchers on problems defined by the community and solutions led by the community. It's a partnership of all the groups you see on the slide here. We are piloting a parametric insurance approach. And then there's also, as part of the project, some research we're doing, some capacity building activities, and helping build a community of practice around these concepts in the city. So I'll tell you a little bit about the policy pilot. So the overall problem statement was to increase the financial resilience of low and moderate income households in New York City to escalating flood risk through the use of inclusive insurance. So that's the general model. The city sort of very quickly decided that they wanted to focus on flooding from heavy rain events. So for those of you who aren't flood people, floods can be caused by many different sources of water. So you could have coastal storm surge. You could, from like a big hurricane, there's kind of coastal tidal flooding. There's riverine flooding when rivers overflow their banks. And this region of the country is seeing increases in flooding from very heavy precipitation events. So we're seeing more of our rain as climate change advances come as heavy downpours, and that can overwhelm stormwater systems and lead to localized flooding events. And New York City has been dealing with this quite seriously in recent years as the remnants of Ida came through, and they had another event. So in sort of the August-September timeframe of this year, they had two big flood events that caused flooding in areas that were not on the FEMA maps, caused a lot of damage, very sadly also caused loss of life. And the city's been really thinking now about how to better manage this stormwater. So that's been the focus of this pilot. And what we did was we started in phase 1 by saying, what are the different ways, what are the different types of interventions that the city could adopt to meet that goal of trying to improve financial resilience for low-income households? And it could be a range of things. It could be some of the microinsurance tools we talked about. It could be a direct public assistance program where they just provide direct assistance to people. It could be, providing means-tested assistance on National Flood Insurance Program policies. It could be targeting mitigation and things that might lead to insurance discounts, right? So we went through all these different types of ways that you might meet your kind of goal. And then we did a very intensive stakeholder engagement process where we talked to all different stakeholders in the city about what they thought about these different types of policy models. And I maybe should have said at the beginning, this grant has a 12-month clock. So we had to have a pilot happening on the ground within 12 months. So that was like a very, that that kind of eliminated a lot of policy options, because there were several things, like we looked at the city sort of purchasing a community insurance product, and it was quickly apparent that it was going to be years before the city was in a place to actually be purchasing insurance itself. So maybe that would be interesting to explore longer term, but it couldn't be done in our time period. And other things we heard were just not going to work for various different types of reasons, institutionally, politically, and some just didn't seem cost effective. So we eliminated a bunch of those options, and ultimately zeroed in on this model, which is what we're piloting, which is the Center for New York City Neighborhoods, which is our partner. They are a group that works on affordable housing for New Yorkers, and since Sandy has been very focused on helping with disaster recovery and resilience for the population that they serve. They're going to be purchasing a parametric flood product from global reinsurers. And when that product triggers, and I'll get to that in a second, so when there's a flood event, they get the payout, and then they use that to make emergency cash grants to low-income households. And it was thought, there's pros and cons to every model, right? And so the kind of benefit of this is that it doesn't put any risk on the household that they might suffer severe damage and not get a payout, because the Center for New York City Neighborhoods can look at where the damage is and make sure that they funnel resources to those who are most in need. But it does mean that individuals don't have individual contracts that they can count on, right? This is more like using insurance to fund an assistance program that this NGO is doing. And that's sort of this interesting bet on whether going forward, it might be possible to sort of change the philanthropy around disasters. Because right now, after a big disaster happens, lots of people want to give to help. And what we've seen with several of the partners we've talked to, who are groups that kind of go help communities in the aftermath, is that they then have to spend sort of weeks after a disaster courting philanthropic dollars when they want to be in the community on day one helping. And so wouldn't it be great, they're thinking, if we could convince our philanthropic donors to instead pay a premium so that we just get that money right away and could just begin work right away. Whether you could change the kind of financing around how we pay for disaster recovery, I think is a very open question. I do think that the way that we currently fund disaster recovery, not just through our philanthropy, but at a federal level, is really unsustainable in the face of rising climate extremes. And so we do need to be testing out and trying to learn from new models. So we'll see. This is going to be piloted in several different neighborhoods around New York City. The final ones are still not decided yet. But we basically looked at a different number of ways to prioritize neighborhoods and basically largely settled on the simplest thing, which is where's there high stormwater flood risk and where are there also low-income residents at risk of that type of flooding. And so we're now in the process of actually designing this product. One of the really challenging things is that there's never been a rainfall flood related parametric product on the market. So there are no set triggers for it. There have been coastal surge products. The New York MTA has a cap on that triggers on that, but we can't use surge gauges because it's not at all correlated with rainfall flooding. Similar for the riverine gauges. We thought about using just volume of precipitation as the trigger, but even that's not that well correlated with damage. And whether or not the flood causes damage depends a lot on antecedent conditions that wouldn't pick up. So now we're looking at a whole bunch of new and exciting technologies that can try to capture flood footprints as they happen in real time, because this is also pretty flashy flooding. So we're looking at things like satellite data and on the ground sensors. There's a really neat network of flood sensors being put up around New York City in a partnership between the city and a bunch of university partners called FloodNet, if you want to look it up, and they're putting it on Department of Transportation infrastructure using kind of radar to measure flood depth in real time. So we're looking at whether we could use things like that to design the trigger for this product. And then, as we were talking about before, having to figure out kind of what return period is cost effective. And then there are these other broader questions that I won't spend much time on now, but just to kind of flag that a pilot like this is raising is like, how do NGOs and cities best engage with these global markets? How do we come up with new solutions for these increasing risks that can meet local needs, but also be things that are comfortable in the market and comfortable with regulators? And then also the city's having to think, where does risk transfer and these types of insurance things fit in with all the other climate resilience policies we have going in the city, right? And they're trying to create this holistic approach to building climate resilience that involves gray infrastructure and green infrastructure and outreach and education, and also the risk transfer piece. And how do you make it all kind of fit together into something that really is enhancing resilience for the city overall? I won't spend time on this so that we have more time for discussion, but we also have some research going on and this kind of capacity and capacity building. Okay, so last slide. I hope I sort of convinced you that recovery from climate disasters is harder in frontline communities, but risk transfer has an important role to play in managing the growing risk of climate extremes. But to get to sort of inclusive insurance and more equitable recoveries, we really need innovation, and that's in policy and the private sector, with a focus on how to make risk transfer work better for people. And I think that's going to require, as I was saying, these partnerships across sectors and a lot of investment in sort of boundary work between research and practice and between the public and the private sector. So that's all I have. I think we still have like 10 minutes for questions. So
that's all. Well, thank you for covering so much. And I will take questions from anybody who has them. I got a million, but I'm not going to ask them. Anybody? Josh, you're nodding. Is that the same as a raised hand? Okay.
Yes and no. I mean, I learned a lot.
Me too.
I learned a lot about this, and I mean, there's no question. You're focused very much on in my opinion, and correct me if I'm wrong, on sort of the ex-post world. Disasters are going to happen. People are going to be affected. Insurance is a great tool for solving the ex-post world problems. And how can we make it work better and have it reach the people who need it? And because, you know, you showed earlier towards the beginning of your presentation, you're showing the outcomes of sort of people with and without insurance and how insurance really makes a difference. So I applaud all that, but I really applaud all that. But I often, in thinking about insurance, I'm thinking about the ex-ante world and the incentives that are set. And so when you talk about flood insurance, you know, incentives for where people live or where people rebuild more likely, right? No, we've all made our first choices about where we're living and things. So, you know, where does that fit in? So,
yeah,
if people can't afford insurance that's sort of priced to actually reflect risks, you know, these are signals that maybe this is not where you should be living or rebuilding. And I'm strictly talking about flood insurance right now, right? But because that's a more predictable types of disasters, whereas others are far less predictable. And so my thoughts were mostly focused on flood. You know, where does that kind of thinking fit into this, or is your answer, you know, you appreciate this is important, but it's just not your focus, that your focus? Yeah.
No, that's not my answer. I think that is hugely important. And I have several things to say. So first I want to say that I think that the concern about subsidized insurance or insurance availability at all causing incentive problems with locating in risky areas is not really a problem if you're talking about very low income populations. If you're talking about the entire distribution, then I think, yes, that you need to kind of be more aware of that. But often for this work, we've been looking at, and we thought hard about this in New York City, and most of the population that we're trying to reach in that pilot are just sort of trapped where they are, don't have lots of other, you know, so I don't think that any program like this or any small micro insurance program is going to entice people to live places they shouldn't, if you're talking about the low income people. Now, bigger for our society, yes, I think that's a huge question. And I think we also need to do a lot more to harness insurance for those ex-ante risk reduction benefits. And I think we haven't pushed enough on well, actually on several things, on some other ways. So I think most of the work on that has been like, oh, well, we can provide premium reductions if you harden your home because now the risk is less. And lots of states mandate that throughout the Southeast, at least when it comes to home hardening for hurricanes. And I think it might also be true for earthquakes in California, but I'm not totally positive about that. But there's actually not good research, and I just don't know the answer because there's not good research on whether those types of premium reductions actually incentivize more mitigation or just reward people who would have done it anyway. Because you still have this problem of needing to make a huge upfront investment that people might not have the funds to do, even if the payback would be worth it. And often the premium reductions are not enough to make the payback period time sufficient. But I think there's a lot of other models we could think more about though, and one is taking advantage of the disaster to invest in mitigation then, because building back stronger is always, cheaper or typically cheaper. And we're not doing enough of that. And often there's all sorts of incentives from all parties involved to build back in the same place and the same way it was before. And so one thing we've been looking at recently has to do with relocation and being able to actually move somewhere else. And so California, for example, has law that insurance companies have to pay the full cost of a claim, including any types of add-ons and riders to the policy, even if the person walks away and buys a new home somewhere else or rebuilds somewhere else. And that seems great, except if you're talking, and maybe is a good thing for fires where you're just trying to get people recovered faster. But for like coastal areas, what you need to do is actually be coupling that to some type of buyout program, because you don't want, as we've seen after some disasters, to enable the current owner to get to leave and get back on their feet, but then someone else just moves back into this highly risky area and then they're in trouble later on. So but coupling those types of things to a buyout program is really hard because our federal buyout programs are so slow. They take like on average 5 years to get money to people. And so we've been looking at a bunch of ways, and some state and local buyout programs could maybe help do that. I'm now off on a tangent. I'm sorry, far from your original question. But I had one other thought on your original question too, which was narrowing in on climate risks. And I think, there's a lot of hope I think there had been a lot of hope from economists that insurance pricing could help lead us to more economically efficient adaptation. But the problem is that insurance is not a good tool to send informational signals or financial signals about climate because they're only 1-year policies and nobody buys it anyway. And so if you're only pricing for this year's risk, you're not telling people about how that risk is going up over time. And I think that's a huge gap that we need to kind of figure out how to start filling, is how to make people aware when they're moving in somewhere that the risk today is not what they're going to see 5, 10, 50 years down the road. But we can't even do a good job telling people about today's risk. So that's going to be hard. Sorry, I think I rambled a lot. I hope I answered your question somewhere in there.
Nope. Okay, Travis, you're next.
All right. So, amazing, Carolyn, and thank you for presenting. It's fascinating. I also learned a ton. So, I don't know that much about parametric insurance, but for someone who's sort of enmeshed in insurance from the legal perspective, parametric insurance doesn't really look like insurance a lot of the time, because because the defining feature of insurance is the indemnity requirement, and my understanding is that that's not strictly necessary for a lot of parametric products. You just pick an index and you bet on it. So it looks more like a gamble than insurance. And if you think the defining feature of insurance is that it's not a gamble, then it doesn't look like insurance. Okay. So my question, I guess, is what's at stake for you in making this argument in categorizing this as insurance? Why not just let it be a financial derivative? And you could, and I ask that partly because half of the moral hazard equation presumably isn't present here because you can't change the weather. It might incentivize you to build your house where you otherwise wouldn't, but maybe the moral hazard problem is at least diminished. You might say that, it seems like you might say that, well, I'm fine with this being a financial derivative in principle so long as it's micro rather than macro, because the sort of perverse incentives are avoided so long as you keep the bets small. And maybe that's but then how does the Miso insurance product work? Presumably the Miso entity itself doesn't, they have to purchase something that seems to me strictly to be a gamble.
So great question and super live issue. And I don't have a complete answer, but I'll tell you a few thoughts. The first one is a lot of the use of parametric designs at a high level of commercial or institutional sovereign. You're right, they're not insurance. They're different types of financial derivatives. There are things like catastrophe bonds, and they're not insurance at all. I think when you start trying to take that concept of these sort of the kind of parametric idea of trigger around a hazard event down to a small scale, one, a lot of the financial derivative structures are just simply not cost effective or viable at a small scale. But a second thing is that I think a lot of individuals need, like they don't want this to be taxable income after a disaster. And so it'd be interesting actually to get some law perspectives on things like that. Most of the parametric insurance that's currently operating in the US, so things like Jumpstart earthquake in California, there's hurricane parametrics operating in the Southeast and Hawaii. And the way these are done is that it's sort of like a double trigger because you have to have some loss. So you don't get a payout if there's no loss. So, but the loss might not be exactly equal to the payout. And the only place where that's not the case is Puerto Rico, where the insurance commissioner waived proof of loss requirements. And the reasoning was that if a severe hurricane or earthquake hits Puerto Rico and these payouts are $10,000, there is no way that households don't have at least that much in damage. Because even if they didn't have severe property damage, like the electricity's down and they have to buy a generator or their roads cover, like whatever it is, there's no way they're not suffering financially and need that $10,000. So only for microinsurance did they waive that. The other ones, you have to show that there actually was loss at the structure. And so then you'd want to make sure in order to have the benefits of parametric that you can do that quickly. So Jumpstart texts you and said, did you have financial losses from this ground shaking that just happened near your house? And you have to be like, yes, I did. And then you get the money. That was okay for the California regulator. But yeah, I think it's a really important question that needs to be thought more about, is my bottom line.
All right, Dennis Wall is next on the queue. And maybe that's the last question because Carolyn may have to go. Okay, Dennis.
My question has been answered. Thank you.
Oh, all right. Walter. Nope, you're muted, sorry. Walter, we can't hear you.
How about now?
Yep.
Because up
Good.
the last 2 seconds was really, really brilliant, but I was on mute. The thing I always think of listening to Travis's comment, there's lots of insurance that pays when something occurs, but the amount has really nothing to do with the loss. That's all over the place. I mean, you could look at, there's various types of, you get cancer, here, we give you a check. We don't know what the loss is. It happens all the time. So it's not unusual. It's not, you may not like it as a form of insurance, but there's lots of insurance that just pays on the event and pays something.
That's actually really interesting. We haven't looked at any of those types of models in other lines. I'd love to.
Yeah, but I mean, there's like long-term care could pay you. You hit a button and you just get a certain dollar amount of payment, whether it's related to how much you actually need in long-term care or not. Cancer insurance, other types of insurance just kicks out dollars if something occurs.
That's a really interesting point. Thank you for that.
Okay, so we have 1 minute, and anyone who needs to go obviously can just vanish into the ether if you want. Carolyn, you care to stick around for a little bit more?
I can stick around for like 1 or 2 minutes, but then
Okay.
I actually have to pick up a kid. So
Of course. Can I just ask you quickly about the supply side? So you have, you're trying to create the demand, but do you have somebody who's going to, like in the New York pilot projects, somebody who wants to fund the other side of this?
yeah, excess interest from the supply side. Capital providers are excited to come into U.S.
No
disaster,
kidding.
particularly with the public sector. Yeah.
Yeah. I'm surprised, but maybe I shouldn't have been.
Let me clarify. Global reinsurance is interested. Yeah. Yeah. Not. Yeah. Yeah. Right.
Okay. Well, come back in two or 3 years. How are you going to evaluate? Like, when are you going to stop this?
Yeah.
Or?
Hopefully we'll have the product. We have to have the product purchased by October.
Okay.
So that'll happen. Yeah. And then we'll continue to kind of evaluate and see how it goes. But also thank you so much for this invitation, and please reach out with any other thoughts or questions or anything. It's been a nice conversation.
Wonderful. Thank you very much. And yeah, do come back when you know what you've learned.
Yeah. Yeah.
Okay.
Good or bad. Okay.
Yeah, whatever. Thank you all so much. Thanks for
Thanks,
coming. See you
everyone.
next week. Bye.